All right, ladies and gentlemen, we are back with another podcast. This one is for Monday, May the 1st, 2023. That's right, ladies and gentlemen, this is a new month. The year seems to be going by pretty rapidly, in my opinion. So, as you may have heard or read or seen on TV or what have you, social media, we're going through an economic downturn, to put it lightly. It's a multifaceted situation where the banks, the big banks even, are having some stress. Do you remember not long ago there was talk about the banking stress tests, and they assured everybody that the US banking system was sound, that the US banking system was safe, and that it no longer required extreme measures as far as having banks to put certain amounts of money in reserves. They then proceeded to relax those guidelines because they felt comfortable in doing so. They said everything is okay. Well, fast forward to today, and now we realize that everything is not okay. We had another bank get taken over this weekend. Somehow they got JP Morgan to bail this bank out, to basically buy this bank. So this is reminiscent of the early 1990s when we had the roll up. For those that are not familiar with that terminology, a roll up is when larger companies absorb smaller companies. They buy them out, they take them over. And when they would roll these companies up into the bigger companies, a lot of times they would keep the original name and concept, even employees, CEOs, whoever was working there at the time they rolled up the little company into the big company, they kept everything the same. Now, the industry where this happened was the funeral industry, where large corporations bought pretty much every funeral home you can think of. And they were smart, they were clever, so they could operate behind the scenes. They would keep the name of the funeral homes and everything. Nothing would change, just the paperwork would change, showing that the big corporation now owns the little mom and pop. And this happened all over the country, to the point now where it's like five or less large corporations that own pretty much the entire funeral industry. So there's a monopoly in the funeral industry. You would never know this because the names of the funeral parlors have not changed, the employees have not changed. It's only on the paperwork. And that's the same thing that's happening now in our banking sector. Well, we're going to have fewer and fewer banks. Larger banks are going to swallow up the smaller banks. And there's a reason for this. This is a phenomenon that came out of the 1990s. This is not the first time that we see this happening within the federal government either. For those that were alive during the time, you can remember in the 90s when we had the government shutdown when Bill Clinton was in office. And at that time, not only was it the longest government shutdown in the country's history, but some interesting things happened during this time. There was a roll up within the government, and there were agencies that were torn down and taken away that no longer exist. And whatever pieces or parts of it that they wanted to keep, they just rolled it into an existing government agency. We didn't really see them create new government entities and agencies until after 9/11. After 9/11, that's when we got the Department of Homeland Security, which is an amalgamation of several departments of government. So this is happening again now, and it's happening in the banking sector. But this one's a little different. Yeah. The federal government may be killing the private sector in order to save said government. Very interesting. Haven't seen this before. All right. Someone's saying they can't hear me. All right. On my end, it's showing that everything is fine. So I don't know what the problem may be. Yeah, I don't know. On my end, it's showing that it's coming out okay. You may want to check your audio settings on your computer. If you're listening on a cell phone, you would have to check your settings there too, because I'm not sure on that. I don't know what to say on that one. But I'm not surprised. This wouldn't be the first time too that I've had issues on YouTube where people said they couldn't hear me, or the video goes out, or I get kicked out altogether. So it's very interesting. But again, not the first time. Not at all. Not at all. Let's see here. What else we got? All right. So I know this sounds crazy, but like I said, the Fed may be killing the private sector to save the government. And it's not really far fetched either. The Federal Reserve's balance sheet reached its all time high in May of 2022. Since then, it was supposed to drop at a steady pace and shed $3 trillion by 2024. Now, the normalization of monetary policy was built on the idea of a soft landing for the economy. However, the Fed may be killing the private sector to save the government. Curbing inflation requires a significant reduction in the money supply and aggregate demand. However, if government deficit spending is left untouched, then the entire burden of normalizing monetary policy will fall on families and businesses. So this is why the current situation is the worst possible scenario. The Fed's balance sheet is not falling as fast as it should. Government spending has not even been scratched, but the money supply is falling at the fastest pace since the 1930s. And rate hikes are hurting the productive economy, while the government seems unaware of the need to reduce its bloated budget. Now, if you recall, for the past decade, Peter Schiff, amongst others, have pointed out that the government could not raise rates because it would destroy the economy. This is what he meant. This is what he was talking about. So now the first quarter GDP figure is extremely concerning. Government spending showed yet another big rise at a 4.7%, and that's a plus 4.7%, which is much higher than expected. However, consumption at 3.7% annualized was well below estimates and driven by a worrying new record in credit card debt. Even more concerning, gross private domestic investment fell by a massive 12.5%. There's robust evidence of a negative trend in the real economy. Now, rising federal expenditure, more bureaucracy, higher taxes, and weaker activity in the part of the economy that drives growth and jobs. Rate hikes have two directive narrative effects on the economy if the government does not reduce its deficit spending spree. They mean higher taxes and a massive crowding out of available credit. The government deficit is always going to be financed, even if it is a higher rate. But this also means less credit for business and families. You see the credit crunch tightening taken into effect. Now, the crowding out effect of the public sector over the productive economy means lower productivity growth, weaker investment, and declining real wages as the government keeps inflation above target by spending additional units of newly created currency. But the productive sectors find it harder and more expensive to find credit. Additionally, the government borrows at a much lower cost than even the most efficient and profitable businesses. It is impossible to achieve a soft landing for the economy when the Federal Reserve ignores the signals of the banking system and the real economy. The first pillar of a true soft landing must be to preserve the real disposable income of workers and the job creation and investment capabilities of businesses. When the government continues to increase spending, there is no signal of the mindset budgetary control, and the entire landing comes from the private sector. What we get is upside down economics. We don't want that. You don't ever want that. This is not the trickle down effect that Reagan was talking about. This is something totally different. The Federal Reserve has stopped paying attention to monetary aggregates just as the money supply is contracting at an almost historic pace. Even worse, the money supply is contracting, but federal deficit spending is untouched. And the debt ceiling was raised yet again. The money supply is collapsing due to the inevitable credit crunch and the difficulties faced by consumers and businesses. It is impossible to grow with rising taxes, persistent inflation, a tax in itself, by the way, and carrying the entire burden of the normalization of monetary policy. Fighting inflation without cutting government spending is like reducing weight without eliminating fattening foods. So come on, you can't do it. I mean, they have to know better than this, which means it's being done on purpose. Always remember that. If you can't, if it doesn't make sense, it means it's being done on purpose. It's not incompetence. And I'll tell you something else is not incompetence. They keep pushing the religion of green, the green. Everything's green, and yes, it has become a religion. But did you know about the hidden costs of renewables? Since we're talking about banking and monetary situations, let's talk about the hidden cost of renewables. All right. Investments in low carbon energy hit $1.1 trillion in 2022. Shortages in crucial industrial metals and rare earth metals could lead to rising prices for renewables. Hydrocarbons remain very crucial for energy security, since they like to throw around the word security. Now, last year, investments in low carbon energy hit $1.1 trillion, which is a record high and a major increase on the previous year. However, this record investment did nothing for the world's energy security. It seems because besides the record investments in renewables, 2022 was also a year that saw a major increase in oil, gas, and yes, coal demand. Not only that, but warnings multiplied about more fossil fuels investments that will be needed. Even the head of the International Energy Agency warned earlier that the oil market is facing a shortage later this year in 2023 because of a growing gap between supply and demand. Now, in such a context, when the most developed economies in the world are striving to reduce their dependence on fossil fuels, one cannot help but wonder why they are also encouraging more fossil fuel production. See the quagmire? Germany, for instance, just closed its last three nuclear power plants, a low carbon source of electricity, but expanded a coal mine. Huh? The United States federal government is spending billions upon billions of dollars on alternate energy, but it is insisting that oil producers boost their output. Huh? Britain wants to become the Saudi Arabia of wind energy, as former Prime Minister Boris Johnson said, but gas demand hit a record last year. Something doesn't seem to be adding up. This something is the hidden cost of renewable energy. It is not something widely talked about because it has the potential to derail transition efforts by casting doubts over the viability of the transition. Yet the issue is very much clear and present. Why else would China be building as many coal power plants as the rest of the world, despite boasting the world's most wind and solar capacity? Hmm. Well, this goes back to the G7. All right. Remember the maintained Russian oil price cap at $60 a barrel? Well, many critics of the transition to wind and solar argue that the biggest problem is that these are being touted as cheaper than fossil fuels. And the calculations to do that are made on the basis of something called levelized cost of energy. The levelized cost of energy is a simple measure per the US Department of Energy. LCOE measures lifetime cost for an energy installation divided by energy production. It sounds straightforward and simple enough. The problem is it isn't. LCOE is not a comprehensive measure of cost because it only factors in upfront costs and the cost of operating a wind or solar farm. What it markedly does not factor in is the cost of energy that is not produced by these farms when the sun is not shining and the wind is not blowing. These are some substantial costs because when wind and solar are down, fossil fuel plants need to step in and fill that gap. And the electricity they produce has become expensive because of those cheap renewables. But besides the LCOE, which proponents of wind and solar have used for years to argue for their affordability, there are also other costs that are making themselves known right now. Raw material prices are going through the roof, and there is little anyone can do about it. Daniel Yergin wrote in an op ed for the Wall Street Journal that the transition would kickstart a mining boom. The reason is that wind, solar, and EVs, electrical vehicles, require massive amounts of metals and minerals, and these are not being produced at anywhere near the necessary scale. And this means some shortages may well be looming over the horizon. Copper, for one, is a case in point. The Trafigura warned last year that there was only 5 days worth of copper supply in the world inventory. Not only this, but that inventory was likely to shrink further to just 2.9 days worth. Just how dangerous this is becomes clear when the fact that ordinarily the world's copper inventories are measured in weeks. As a result, copper prices are about to hit a record this year again, according to the Trafigura. This is not going to do anything about the affordability of wind and solar, especially given that it is not the only commodity in short supply. Everything is getting much more expensive in an already stretched wind industry supply chain. A senior at Siemens told the Financial Times late last year. In the US, the Biden administration last suspended exorbitant tariffs on Asian import solar panels after these caused a slew of new project delays and cancellations because of what? Higher costs. No wonder then that the wind and solar industries are finding life hard at the moment, despite upbeat reports that continue to insist that wind and solar are the cheapest source of energy. This is why oil and coal, too, continue to be essential for the world's energy security. The LCOE may be higher than wind and solar's, but so is the reliability, because unlike those two, fossil fuel power is dispatchable. It can deliver whenever it's needed. And let's face it, oil and gas production and processing requires a lot less metals and minerals than manufacturing solar panels, inverters, cables, and wind turbines. For that low cost, low carbon energy, that is, essentially neither of these. So, not knowing what's up, not knowing what's up. So, again, these are issues that are uncomfortable for the establishment to deal with and talk about. And there are some consequences that have already come into play because of this. And we'll go deeper dive into that in our next podcast. But yes, we are facing economic disaster right now as I speak. And it's only going to get worse. And yes, they're trying their best. That means they are doing their best to keep the market propped up, but they're even failing at that. This is why the stock market is about to crash, and I mean crash hard, because you can only keep up the mirage for so long. Eventually, everything is exposed, and there's nothing they can do about it. So this week being the FOMC, it's going to be very interesting because they can't do anything. They've backed themselves into a corner. You can't really raise rates more than 25 basis points, and you really can't lower rates either. No matter what they say or do, the effects that it's going to have on the global economy, not just the U.S. economy, is going to be devastating. So get ready, because this is good. This is the time. If you have been patient up to this point, this is going to present itself as an opportunity to make more money in these markets than you've ever dreamed or thought possible, because some really crazy market moves are upon us. And it's going to make people, it's going to leave them speechless. I can already see people fainting at their keyboards because they're not going to believe what's happening. But it's going to happen. And it's going to take a lot of people by surprise, because everyone is so bullish. Oh, we're not in a recession, and we're not going to have a recession. Okay, that's fine. And I know the debate still rages. There, you got the bullish arguments, you got the bearish arguments. A lot of people say, oh, whatever. But I'm here to tell you the price action does not lie. And even if they are successful with having, staging a little rally, it's about to fizzle out and fizzle out hard, because there's certain things that you just can't hide. There's certain things that you just can't hide, because it's gonna show itself. Like, where do I hide an African bull elephant in the living room? I can't. You cannot. In a crowded living room, you can't. Anyone's going to see, people will be able to see it from outside the house, more or less inside the house. And that's what's happening right now. You got an elephant in the living room. And for the longest time, you were able to conceal the elephant by turning off the lights. Not to mention, it was nighttime and it was overcast sky, so there was no moonlight coming in through the window. So no one saw this elephant. But now that the light of day has shown, we can clearly see the elephant. All right, folks, you know what it is. This is another podcast installment. And on the next one, we're going to take a little bit deeper dive, and I'm going to show you some things. Very interesting things are on the horizon. And like I said, people are about to be shocked. You're not going to want to miss tonight's end of day pulse wave report, because a lot of things people are just not seeing, but I'm going to show it to you on the algo charts. And I'll tell you where we're going to go from here. All right. So remember, the system works if you work the system. We're trend followers. We trade with the trend of the market. We're not married to a particular market or position. If the market is bearish, we're bearish. If the market is bullish, we're bullish. All right. And that's just how it is. And yes, you cannot lose heart. If you're on the wrong side of the market, you'll get stopped out, and then you can put yourself on the right side of the market. And then when that momentum and trend is gone, then you reverse and get on the other side of the market. You're constantly long or short. It's just how the game is played. And it's a law of averages, because at the end of the year, you'll see that you came out in the black in a big way only because you put yourself on the right side of the market every time. You don't waste. You don't skip. You don't say, "Oh man, that last trade hurt me. I'm not getting back in," because the trade you miss is the one that would have put you back in the positive. But because you missed it and didn't take it, you're still in a deficit. All right. So just remember that. These are the skills that you're going to need moving forward, because volatilities are going to increase and a whole bunch of things are going to be happening, and it's going to be crazy. Yeah, I know about the doom thing. Yeah, they've been talking about the doom forever. There's this one guy, I forget the name. He talked about Armageddon and all the stuff, and we've had some moments of market crashes here and there, but they never stayed that way. And one of the reasons why it doesn't stay like that is because the market is literally designed to only go up. We have moments of crashes, yes. But if you take a look back over the last 50 years, every time the market was down, it was short-lived. It never stayed down, because the market is by design. It's built in that way to always go up. And even if that fails, they have a fail-safe called the plunge protection team. They will come in, and the Fed will start just buying securities and buying the S&P futures and doing whatever they got to do to keep it afloat. All right, so it's just what it is. But it doesn't mean that that's always going to work. And for the last 20 plus years, the system that they have been employing for market management has been faltering. And that's why you've seen all this volatility, because the wheels are falling off the bike. All right, it's just what it is. All right, so it is what it is. Let's see, question. So if they are going to kill the USD, doesn't hiding in equities and the melt up make sense rather than the crash apocalypse? Well, I would say under normal circumstances you would be correct, but there's a lot going on, you guys, and not just the economy, the U.S. economy, but the global economy. There's a lot going on right now, and this thing could fall apart at any moment. That's my whole point. But if this was any other year, if we didn't have a war going on with Russia, if China wasn't threatening to invade Taiwan, if the banking crisis wasn't being covered up because it's worse than what you thought and what you could even imagine, if the derivatives debacle wasn't an issue, we have too many issues. And because we have so many issues, it's like death by 1,000 cuts. You might not bleed out immediately, but you will eventually. So that's what we see happening here. And until something gives and fixes, it's not going to. The U.S. is worse off today than it was 20 years ago in a lot of ways. I mean, the country has become one big giant tent city. We have the homeless by the tens of the thousands. It's gotten so bad you can't even cover that up anymore. We didn't have that 20 years ago. Now you can go to just about any state in the union and you'll see tent cities. We didn't have that 20 years ago. We just didn't. And now the Fed wants to crash the economy even further. He said so. He needs the unemployment rate to go sky high. That's how they're going to fight inflation. His words, not mine. So what do you think that's going to happen? And then you see all the retail stores going bankrupt. You got Best Buy going bye-bye. You got Walmart closing hundreds of stores. Now Bed Bath & Beyond, gone. It's a laundry list of chains that are just going away. Party City just announced going bye-bye. That's not a strong economy. And no matter what they say about inflation, I'm sorry. All you got to do is go to the grocery store. There's a reason they took out food and energy from their numbers when they talk about, when they compile inflation and things like that. There's a reason they took out food and energy. It's not because it's volatile. The Weimar Republic situation was volatile. This food and energy are not volatile. Food and energy are the true gauges of inflation. Food and energy are the true gauges of economy. Food and energy are the true gauges of supply and demand and consumer sentiment. That's why they took it out of their numbers, because it would expose everything. The whole circus would have came to the big circus tent would have imploded years ago if they didn't do that. That's why they did it. All right. So anyone who fills up their car with gas, anyone who has gas for heat in their home or electric for that matter, anyone who pays an electric bill or utility bill, anyone who puts gas in their car, anyone who goes to the grocery store knows the real truth about inflation and the real truth about this economy. And like I said, it's death by 1,000 cuts. And I said a long time ago, back in 2013, I said the worse the U.S. economy gets, the higher the Dow will go. And back when I said that, the Dow was nowhere near the price it is today. All right. Not even by it was more than 10,000 points lower than it is today. Everything I said then has come to pass. The worse the U.S. economy has gotten, the higher the Dow has rallied. And here we are today. All right. Can the market remain like this? Of course it could. But we know it's not, because there are too many problems. And the tech sector alone cannot move the entire market. The market is more than the tech sector. And I know you've been hearing about AI this and AI that. It's just a new AI thing. You can't compare this AI thing to the tech bubble of the late 1990s. It's not even in the same department. We've never seen anything like the 1990s. The 1990s was a rare bird, and it has in a class by itself. It just is. You can't compare anything to it. We don't have that right now. We just don't. This is a different scenario, because in the 1990s, America wasn't on the verge of collapse like it is right now. America is collapsing socially, economically, spiritually, and yes, physically. You add all those components up, and it doesn't leave you with a very good picture. Now, does it? That's why I said the things that I said, because these are the realities that we are dealing with right now. And we don't run from reality, we deal with it. You got to deal with it. You still got to live in this world, but you need to understand what the temperature is outside before you just walk out there. You need to be aware and alert to what's really happening. And I don't know if people are really willing to wake up because it's painful. It's painful once you realize that everything that you thought was a lie. To have your worldview destroyed is a very violent thing. And it takes a toll on the human psyche. So it's not something that we take lightly. And everyone is at different stages of enlightenment, but it's getting to the point now where even if a person is just stubborn and doesn't want to see the truth, it's impossible for them to hide from it because it's staring them right in the face. What are you going to do when the truth is staring you right in the face? I mean, you can still pretend that you don't get it. You can pretend. You can play that game. Yeah, that's your prerogative, but it doesn't make the truth and the reality go away. Just because you ignore something doesn't make it disappear from reality. It's still there waiting for you when you come back around. It's still waiting for you to sober up. It's not going anywhere. It's just waiting patiently. All right, folks. That's all I got time for today. I like to keep these podcasts short, about 30 minutes or so. You know what to do. Smash that like button if you feel that you got something out of today's podcast. That would be helpful to me, of course. And I'll see you in the next one. Like I said, tonight, it's going to be an interesting end of day report. And you don't want to miss that. All right, people, you know what it is. It's your boy, the Algo Capitalist, aka the Vulcan, and I'm out. Peace.